This is Len Haydachuk. Thank you for listening to our Financial Lens episode titled Looking Back, Looking Forward. It's always important when we do financial planning to look at current situation is, have a assessment of where we've been, but more importantly, where we're going. And that's what we're going to take a minute to do during our time today. We're going to look at 2022 and see what happened. As we all are aware, the 2022 period has been marked with inflation. Inflation is the death knell of economies, and that's the number one priority of central banks to curb inflation. And so the Federal Reserve increased their Federal Reserve rate 7 times in 2022, 4 times at a rate of 0.75%, twice at 0.5%, and once at 0.25%, for a total increase of 4.25%. That is unprecedented in history. When interest rates go up, stocks and bonds both lose money. The reason bonds lose money is when folks have a bond that pays a certain rate. When you have new bonds issued at a higher rate and consumers are stuck with their rates that pay a lower rate, they have to sell their bonds for a lower value to be able to sell them. So the increase in the interest rates causes bond values to go down. It also causes the stock values to go down. The reason for that is when interest rates go up, that makes money more expensive to borrow. You have less consumer consumption, less investing, and the interest rates cause the value of stocks to go down by their profits to go down and their values to go down. We're going to have we will continue to have high inflation until the wage rates are under control. There is low unemployment. The employees are getting high wages, and this is due to a few factors: consumer demand, and also the imbalances or the distortions from the supply chain due to COVID. We still haven't gotten beyond that. So until the wages are under more control, we will not see a decreased inflation. And also the energy prices have created inflation, and they have stabilized somewhat. But because of the war in Ukraine, we might still see some pressure in the energy prices, which tends to affect economies negatively. So what does that bode for 2023? Well, we do expect the Federal Reserve to keep their policy of tightening their monetary policy, making credit less available, and we do expect further increases in the Federal Reserve rate. We don't think they'll be quite as high, but we do believe that they will increase their rate and continue to do so until it gets to perhaps a 2% target, which will take a few years to do that. So we do expect a recession. We expect a global recession in the United States. We expect to see that in Europe. We expect to see that in China. And what the result of that will be is unknown in the short term, because we don't know how prolonged it will be and how much of a domino effect it will have, affecting many different industries and economic sectors. But we do expect a recession. How that will affect the stock market is unclear, but we do believe in the long run the stock market might have someplace around a 4.5% to 6.5% increase on average over the next 10 years, an average of maybe 5.5% to 6.5% perhaps. Bond rates will be returning maybe about 4 to 5% in the long run. And so what we see is the spread between stocks and bonds narrowing. And what that means is that risk in the stock market will not get that relative payback like it did in times past. So bonds might be a little bit better hedge for folks who do not like risk. And we also see that annuities are getting returns close to the bond rates, right in that same range. However, they have no fees, but they are less liquid. In the annuity world, we also see what we call trigger returns or trigger indexes. These are tied to the fixed index annuities, and the way they work is when the stock market, the S&P 500, goes up at all, that trigger will kick in and you will get the stipulated rate. We have trigger rates of 10%. So no matter how much the stock market will go up, that product will return 10%. The big opportunity for consumers is really planning taxes. We're going to have a tax increase in 2026. As the Tax Cuts and Jobs Act expires and we revert to previous tax returns, we're going to see tax rate increases. We'll also see an increase in the estate taxes for estates of lower values. So very important to look at tax planning, look at how to distribute money from your portfolio to meet your needs, which really gets us to what really matters to folks that we work with, is to make sure your money aligns with whatever is most important to you. We call this bringing your money to life. We want to make sure that those things that matter most to you, whether it's having money available to enjoy experiences and your relationships, whether it's to build your assets, to have accomplishments, to use your assets for whatever you want to use them for, or just to have more wealth, or to use your money to make an impact for those that you love or causes you feel are important to you. It's important to make sure that whatever is most important to you, you structure your money to do just that. Thank you for listening to the Financial Lens episode titled Looking Back, Looking Forward. Thank you for the privilege to serve you. I wish you a fabulous 2023.